Okay, good afternoon, everybody. Thank you for joining this InvestEngine webinar in partnership with Invesco, which is all about investing in the US. I'm Andy Prosser. I'm the head of investments at InvestEngine, and I'm joined today by Chris Mellor, who is a product specialist at Invesco. Now, in terms of the plan for the webinar, it's going to be a bit of a Q&A between myself and Chris. So I've got a few questions, which I think people will likely want to know the answers to. So we'll start off with some of those. But I'm also going to be picking some questions from the Q&A as well for the end. So if you do want to ask questions as we're going through the webinar, you can click, there should be a Q&A button at the bottom of your screen. The questions, they're not going to be broadcast to the whole webinar chat. They'll just come straight to us as panelists. So don't worry if you think you've got a stupid question. That's absolutely fine. Feel free to ask away and we'll answer as many as we can at the end. Now, it's my job to make sure everything runs on time. So I need to make sure that I leave enough time at the end, probably 5 minutes or so, for a quick demo of how to buy some of the ETFs that we're going to be talking about today on the platform. So I'm hoping that once we've wrapped everything up, we'll be ending the webinar at about 5:40 to 5:45. Before we get going, though, I do need to mention the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial advice. So with that said, I'm going to hand over to Chris. And just before we get stuck into questions, Chris, maybe you can kick us off by giving us a quick intro into who you are and who Invesco are for those who maybe aren't so familiar.
Perfect. Thank you, Andy. So let's start with who Invesco are. So Invesco's truly global asset manager. I think we manage something like $1.7 trillion of assets for our clients across the world. We're also, and this is important for my role, one of the biggest ETF providers in the world, with more than $500 billion of assets under management in the ETF space across US, Canada, and European domiciled ETFs. My role is head of equity product management for the EMEA ETF suite at Invesco. So I guess in short, I'm an ETF geek, and I'm lucky enough to enjoy talking about ETFs, which I do for a living.
So well, let's get stuck into ETFs then. One of the big stories for markets this year has obviously been the US election. And given that this webinar is all about investing at the US, that seems like a pretty good place to start. And we were just talking earlier, actually, we've had a couple of questions come in by email, and one of them was specifically about the US election. So how are investors reacting to the US election result, and how has that impacted kind of wider markets?
Yeah, so I think it's fair to say it's had a pretty meaningful impact in markets. We're now almost a month on from the announcement of the election results, with obviously Donald Trump winning the election, perhaps with a bigger result than forecast by the polls, and more importantly, the Republicans also taking a clean sweep of the houses as well, which puts him play the possibility of some of the Trump policies actually being enacted. Although, as ever, the caveats are that even with Republicans in the House, or in both houses, he may not get everything he wants going through. In terms of market reaction, generally pretty positive. Certainly in the US, we saw a bounce back in US equity markets in November. Helped by the election result, I think it's fair to say, having seen some underperformance or some losses in October. And if we look at equity market investment flows, so looking at European domiciled ETFs, what investors have been doing in that space, we've seen a surge of inflows into equities once again. About $30 billion were added to equity ETFs in the European domiciled in Europe. Which takes us to already record levels of inflow for the year. About 2/3 of those flows were into the US, or to US exposed products. And that I think is driven by sort of partly the judgment on what the Trump election result means. If you look at the sort of sectors of the market, performance was pretty strong, perhaps for those that you'd expect. Things like financials, things like energy, small cap stocks, all benefited from a variety of sort of Trump policies. Financials from the deregulation story, energy from the idea of focusing more on energy self-sufficiency once again in America, and a loosening of the shackles that some of those stocks or sectors have been under. Small caps, I think, is probably more to do with the tariff policies that have been announced by tweet as well. So generally a vote of confidence in US and domestic US. Interestingly, we saw some modest outflows from European exposure in the wake of the election result.
Mm. And so for investors who want to kind of get exposure to the US, we've also got a few different kind of vehicles that we can invest in. A couple of the major ones, we've got S&P 500 ETFs and we've got Nasdaq 100 ETFs. What do they kind of offer investors? How are they different? And what's their kind of purpose in portfolios?
Yeah, so I guess the first thing to say, what they offer investors is a sort of an easy one-stop shop, a single investment that gives you pretty broad exposure to the US market. S&P 500 is the most widely tracked index in the world, a super liquid, super tradable index that is very cheap to get into and out of for investors in general. And that's giving you that broad market exposure. So if you've got a view on the US, or indeed even if you don't have a view on the US equity market is about 70% of the broad developed market index like the MSCI World. So it's a good low cost way of getting broad equity market exposure. Nasdaq 100, I think it's fair to say, is the leading global benchmark for more innovative company exposure. So if we look at the stocks in the Nasdaq 100, they tend to have higher investment in R&D. So R&D as a proportion of sales for the Nasdaq 100 is about 50% higher in terms of spending than say the S&P 500. And if you look at the outcome that's delivered, growth in sales, growth in earnings, growth in book value for the Nasdaq 100 has been almost 50%, or sorry, 100%, almost double the level of the S&P 500 over the last 10 years. So if you're looking for something a little bit more growthy, a little more punchy for a portfolio, then the Nasdaq 100 is the place that people often look.
Yeah, I think it'd be kind of easy to think, based on recent performance especially, that all you really need to do to invest well is just stick everything in an S&P tracker and like totally forget about it. But there are some risks there, right? The Magnificent Seven, these big seven stocks everybody talks about, make up something like over 30% of the S&P 500 index. So I guess, what are the risks of the market being that concentrated? And are there options available for investors wanting to kind of mitigate that concentration risk?
Yeah, so I guess risk is important to think about, and concentration risk has certainly risen. As you say, Magnificent Seven now makes up more than 30% of the S&P 500 index. If you look at that in context of the longer history, the top 10 stocks in the S&P 500 now makes up 36% of the index today. Compare that to history, the top 10 stocks historically has seldom been more than 25% of the weight in the index. So if we think back to the dot-com bubble, for example, where large cap tech names were again having a big impact, the market peaked out at just over 25% concentration in terms of that measure. I think it does create a risk, which is that if you think about it, the biggest stocks cannot go on becoming bigger and bigger and bigger ad infinitum, and in general, the history suggests that sort of concentration goes through cycles. That doesn't necessarily mean that the market itself has to decline, but it probably means that at some point, some of those bigger stocks will start to underperform versus the other parts of the market, or perhaps to put it another way, other parts of the market might play catch up. One very easy way of positioning for that is to look at equal weighted indices. And actually, if we look at flows year to date, and certainly in the second half, we've seen very strong flows, about $10 billion of inflows into equally weighted products in the European domiciled ETF space. And I think that's been driven by people looking to sort of hedge out some of that risk. I think we actually have a slide, if we can pop that on the screen, which looks at the performance of the S&P 500 equal weight index versus the S&P 500 standard market cap weighted index. And what you can see here is that a simple approach of putting an equal amount into every single stock in the S&P 500 over the long run has typically outperformed. It's slightly hard to see in this chart, but the average number here is around about 4% outperformance on a rolling 3-year basis from the equal weight index. But what you can see as well is that this growth in mega cap tech has seen underperformance from equal weight for much of the last decade. But that does give the potential for a bounce back. And again, you can see looking back historically, when you have extreme underperformance from equal weight, it tends to lead to prolonged periods of outperformance. So again, that's another reason that people are looking at equal weight as a potentially interesting way to go. It's worth saying, of course, that performance is not guaranteed, and past performance doesn't always predict future returns. I'm sure compliance will thank me for adding that.
Okay, next question. Getting slightly more technical, I guess, but I think still quite an important thing for investors to understand is how ETFs replicate the underlying index they're tracking. So people might have heard of physical or synthetic approaches to index replication. Some might not have done, but it might be worth kind of giving a quick explainer of what physical and synthetic replication approaches are and maybe how they differ. And then maybe just a little bit of insight into how the replication method matters for ETFs.
Yeah, sure, certainly happy to do that. So I think the first thing to say is that if you think about what an ETF is trying to do, it's trying to replicate the performance of an index in most cases. Some active ETFs maybe won't be benchmarked to an index, but most ETFs that you'll look at will have the objective of tracking an index. And of course, you can't invest directly in an index. You have to buy a fund, and the role of the ETF fund manager is to try and track that index as efficiently as possible. There are, broadly speaking, two ways of doing this. One is to just buy the components of the index, and actually, if you pop up, I think there's another slide that we can share. So just buying the constituents of the index is what's referred to as physical replication. And it makes sense, I guess, to most investors. If you think about what the index is doing, if you're trying to track the performance of it, replicating it with a physical basket of stocks, it makes common sense to just go and buy each of the stocks in the index at the correct weight, and hopefully you'll track the performance of the index. The slight problem with physical is that it has transaction costs, which for something like S&P 500 is not a big problem, but for other sort of more difficult to track benchmarks, it can create issues. And then you'll see the fund manager perhaps going for the second option there, which is an optimized or a sampling based approach, where they'll own most of the stocks in the index, but not necessarily in the same weights. That helps to reduce the cost of rebalances and the cost of reinvesting dividends and so on. And the aim is still to try and track the benchmark. The other way of replicating a benchmark is a so-called synthetic approach. And what you're doing here is basically using what's called a swap or a swap contract, which is sort of, as the name suggests, it's a contract where you're swapping one return series for another. In this case, you're swapping a return series in order to receive the performance of the index. There are, again, two sort of structural approaches that can be taken here. The one on the right of the screen, the so-called fully funded swap model, is basically no longer in use. That was the way that early synthetic ETFs worked. The fully funded bit there is talking about how the fund is the ETF is actually funding the swap counterparty. So a creation in a fully funded swap fund would take cash in from investors, they'd pass it to the counterparty to the swap, so the investment bank that contract is written with, who would then invest it in a hedge for their exposure and then promise to pay the fund the performance of the index you're tracking. That model effectively died in the global financial crisis because of the counterparty risk that it brought with it. In essence, the risk that the swap counterparty might promise to pay you, but may fail to do so if they go bust. The model that is used now for synthetic ETFs is the one that you can see, one step in from the right, the so-called physical with swap overlay approach. And that basically does exactly what it says on the tin. It's a physical basket of equities bought and owned by the fund in exactly the same way as a physically replicating ETF would do. And the majority of the value of the fund is tied up in that basket of equities. And also the majority of the performance is driven by that basket of equities that you own. The difference from a physical fund, though, is that the stocks that you're buying may not be the same stocks as in the index, and instead what you're doing is truing up the performance of that basket that you own to the performance of the index that you want through a swap arrangement again. In this case, swapping the performance of the basket that you own for the performance of the index you want to receive. What that structure does is sort of fundamentally transform the risk profile of a swap-based fund, because now the only time you have exposure to a counterparty is when the index you're tracking outperforms versus the basket you hold. And that very much limits the exposure that you're taking. It's a very similar level of counterparty exposure to what you'd have with a physical fund, where the physical fund may be engaged in stock lending. Stock lending, just to explain, is where the fund is loaning out stocks to another counterparty and receiving a fee for doing that. And again, there's a counterparty risk that you're taking with that, which is that you may not get your stocks back that you've lent out. So on a par in terms of risk profile is the way I think of it. Sorry, that was a very long structural discussion. To get to the other part of your question, why might you do this? The simple answer is that there are some structural advantages to using a swap-based approach. The counterparties that we work with are able to get better performance, perhaps on certain exposures, than a physical fund might do. The best example of this is in broad US benchmarks like S&P 500 or Nasdaq 100. Swap counterparties generally are getting gross performance, so receiving dividends with zero withholding tax, and they're able to pass that through to the fund, whereas the best return that you can get on a full physical replication or a physical fund will be subject to 15% withholding tax if you're investing in an Irish domiciled product that benefits from tax treaty rates. So that 15% withholding tax advantage translates to a pretty meaningful improvement in performance in ETF tracking terms.
Yeah, I think not a lot of people really understand the difference between the physical and synthetic replications and the advantages of synthetic, specifically in the US over physical, and the fact that you do get this kind of performance uplift from not having to pay the withholding tax. So hopefully that's clarified things a bit. On the synthetic ETF side of things, what are the risks there? Obviously, you have the counterparty risk that you mentioned, and what are some ways that Invesco will kind of mitigate against those risks?
Excuse me. We talked about the advantages a bit. The risks there are really about how much exposure you have to that counterparty whenever the index outperforms the basket of stocks that the fund owns. So there are a number of steps that we take to manage that counterparty exposure. The first is we have a diversified approach, so we use multiple counterparties to the funds. Up to 6 different counterparties on some of our ETFs, so for example, our S&P 500 product, which automatically, obviously, reduces your risk of exposure for the whole fund, because you're now exposed to 6 counterparties. So it's now a fractional part of the fund that we're talking about. The second and perhaps most important step is we're also resetting those swaps on a frequent basis. Specifically, what we do is use a trigger-based approach. So any time that the swap counterparty exposure on any given fund goes above 400,000 euros or 100,000 euros and 0.2% of fund assets, based on end of day closing values, that will trigger a swap reset. And what will happen is the swap counterparty will transfer cash to the fund the following business day, and the fund will then go into the market and buy more equities and cover off that counterparty exposure. You know, for something like our biggest funds, our S&P 500 product at about $35 billion of assets under management today, those triggers are a fraction of a percentage point, less than a hundredth of a percentage point. So any time that you have that swap exposure, it's likely to trigger a reset on the next day. The other key things that we do, the basket that is owned by the fund is composed of listed developed market equities only. We have strict liquidity concentration limits to ensure that that's a tradable basket, as ultimately that's the backstop for the value of the fund. And then we also have strict ongoing risk monitoring of our counterparties. We only work with counterparties that meet our requirements for onboarding. Included in that is strict requirements around the sort of risk profile of those counterparties. And we're also monitoring our counterparties on a daily basis to look for potential risks as well. And then finally, I'd say ETFs themselves are a transparent vehicle, and transparency is at the heart of everything we do. So we display on our website full portfolio holdings, full counterparty exposure details. So you can go and see exactly what it is that you're buying and get all of the details at our website, of course.
Very good. Thank you very much. That was a good explainer into the differences. Hopefully people understand that a bit better now. We've spoken a lot about the US so far. And I think sticking with the kind of synthetic replication theme, can a swap-based approach be used for global equity ETFs as well as US ETFs?
Yeah, so there are benefits to using a swap-based approach in other markets. The most obvious one is the US, where this withholding tax advantage is adding, 0.2 to 0.3% per annum performance, depending on the level of dividend yield on the index you're tracking on a pure US exposure. However, the US makes up a big portion of some of our global benchmarks. So if we look, for example, at the MSCI World Index, I mentioned earlier that the US makes up 70% of the weight in that index today, and we're able to get gross performance on the dividends on that 70% of the index through our swap arrangements. And again, that means that an MSCI World swap-based ETF can deliver better performance with more consistent tracking error than a physical fund equivalent. There are a couple of other examples where there's a benefit from swap-based. In particular, low tracking error is another example, or the reduction of the impact of stamp duty on something like a UK benchmark. But primarily, I think the focus is mostly on US as such a big part of the portfolio.
Now, I'm going to ask this as my final question to you as part of the Q&A session, because I know that people will ask it in the chat. So let's deal with it up front. Costs. How much do these ETF costs? What's their ongoing charges? If you could just shed a little bit of light on how much all the different US products that you have cost, that'd be really helpful.
Yeah, happy to do that. So in terms of costs, there are sort of two areas to think about. So the first is obviously the headline management fee. And we're extremely competitive in terms of the OCF on things like our S&P 500 or our MSCI USA funds, which are priced at 0.05% or 5 basis points. So extremely competitive, among the lowest cost funds in the market. as you go to sort of wider and slightly more complex to tracking instruments, then you're talking about something like, perhaps 0.19% for our MSCI World exposure. The other cost to think about in any fund is the transaction costs within the fund. So a physical fund, it will be the costs of rebalancing and reinvesting dividends, and that can vary depending on the exposure. The other cost that you have with a swap-based ETF is the potential for a swap fee. In the case of our S&P 500 exposure, that swap fee is currently 0.04%. So again, a very low level. The important thing to remember there, though, is that swap fee is being measured versus or being taken off of the index performance that we're receiving from the swap. And in the case of S&P 500 and many of these other US benchmarks, the index performance we're receiving is the gross index, not the net return index. So despite the fact that you have a management fee and despite the fact that you have a swap fee, we're actually able to outperform versus the stated benchmark of the fund. And actually, there's I think one more slide that we can share, which looks at the long-term picture in terms of performance for two S&P 500 ETFs, so UCITS ETF products. The performance we're looking at here is over the last 13 years, and we're looking at performance relative to the standard net return index of the S&P 500. So the light blue line here is the performance of the Invesco S&P 500 ETF, SPXS, as it's often referred to. The grey line is the performance of the largest physical UCITS ETF that was in the market at the start of this period. And what you can see is that first of all, both of those funds have outperformed versus the standard net return benchmark. The reason that they've outperformed is because they're getting better withholding tax rates. In the case of the swap-based product, the Invesco product at the top there, we've been receiving gross performance less that swap fee and that management fee, which is included in the performance line here, since the start of 2018, so the end of 2017. In the case of the physical fund here, it's been receiving improved withholding tax rates because of its fund domicile in Ireland, so it's getting 15% rather than 30% withholding tax on distributions that it's receiving from companies it holds. You can see also there's a couple of other lessons you can learn from this. One is, being an ETF investor today is a better place to be than perhaps a decade ago, where the market was a bit less competitive. You can see both of these funds used to underperform versus the net return benchmark, primarily due to higher fees and slightly worse withholding tax rates, or withholding tax rates in line with the standard index. But as time has gone on, you've seen reductions in fees and improvements in withholding tax rates, which have seen both of these deliver better performance. But ultimately, I guess the last thought I'd leave you with is just those numbers in the header there, which is, if you'd invested $100 million or even $100 in the S&P 500 back in 2011, that would have gone up significantly. So today, $100 million would be worth $559 million today, if it had been invested in our S&P 500 ETF. If you'd invested in the biggest physical fund at that time, and indeed one of the best performing physical funds since then, you'd be about $15 million out of pocket. So, there is a real advantage to swap-based replication that you can see in the past performance of these funds.
Thank you very much. Yeah, that was extremely thorough. Hopefully that's driven the point home that if you're thinking US, you should be thinking synthetic. Now we're coming towards the end of the webinar. We've got about 15 minutes left, and I'm just conscious of time. So I'm going to do a quick platform demo in a second. But in the meantime, if you're watching this, please do feel free, keep the questions coming. And if we don't get a chance to answer them today, we'll do our best to get back to you after the webinar. But for now, though, I'm going to share my screen Hold on. Let me just share screen 2 and do a quick platform demo. Da, da, da. Right, that should be sharing now. Is that good? Can everyone see that? Yeah, there we go. Cool. So here we've got a dummy account to walk through. So once you're logged into the InvestEngine app on your phone or on the web browser, you can either open a new portfolio or select your existing one. I'm going to select the DIY portfolio that we've got here. We've got a roughly equal split. Actually, it's not equal anymore because equities have outperformed, but it used to be an equal split of equities and bonds, and now the stock market's done pretty well. So the equity portion is outperforming. But what we want to do is add securities here. And we have been talking about the Invesco ETFs today. So we just click the Invesco tile on the banner here. And this takes us to the Invesco page, which has got a good list of all of the ETFs that Invesco have platform. We've got a whole bunch of nice cheap ones here. I saw somebody asked a question in the chat earlier about how to find the equal weight ETF. So all you'd need to do there is just in here, literally just type equal, if I can spell it. And then you've got the equal weight here. What I want to do first before we actually invest, though, is just go into this one here, SPXP, the Invesco S&P 500 ETF, because it is useful to see this bit here. You can see in the kind of the tiles that describe the ETF, we have a section here called replication method, where you can see whether it's synthetic or whether it's physical. So you can see here that this S&P 500 ETF is synthetic, so we'll get that uplift in performance from the withholding tax benefits that Chris was talking about. So we like that. So we're going to add that to the portfolio. And we can see it's been added because it's up here in the top right now. And we're going to continue. And here's where we change all the weights in the portfolio. So we're going to make this one 50% of the portfolio, and we're going to get rid of this one. And on the next screen, we should see how that affects our overall portfolio. So here we go. We have an increase in the allocation to North America. We were at 29% before, and now we're up to kind of almost 49% because we're removing a global tracker and putting a US one in there. So that makes sense. Reducing Europe a little bit, again, makes sense. And then we can see the impact on the sectors as well. An increase in industrials, an increase in tech. Again, these make sense because they're big weights in the S&P. And then the holdings change as well. You can see we've got a larger allocation to Apple now that we've put the S&P in there, larger allocation to Microsoft. But we're happy with that. So we save and continue. And we can see the target weights has now been updated. So we should be able to scroll down and see, here we go. We've got the Invesco tracker in here. This shows what your current weight is versus your target weight. So because I haven't rebalanced yet, this is still sitting at a 0% current weight and a 50% target weight. So what I'd need to do here is to rebalance my portfolio, where I'd go options and rebalance portfolio here. That would rebalance everything back to target weights. Now, this is obviously a demo, so I'm not going to go and rebalance everything. But that's how you'd get that Invesco ETF in there. If this was an unfunded account, obviously this is funded because it's got some fictional cash in there. But if you were funding an account for the first time, you would click the invest button here to add a lump sum, or you can click the savings plan kind of banner here. And the savings plans let you invest on a kind of a weekly or a fortnightly or a monthly basis, up to you. So they're kind of a good way just to get that regular investing plan going, especially if you have our auto invest feature turned on, where you kind of make sure that any spare cash is invested in line with your target weights, and that's all done automatically for you. So that is how you access the ETFs that we've been talking about today on the platform. We've actually smashed the timings. We're at exactly 5:35, so we've got exactly 10 minutes to go through the Q&A. So let's have a look and see what we've got in the chat. Okay, first question. A nice easy one to kick you off, Chris. Is the Invesco S&P 500 ETF leveraged? You're on mute, but that was a big no, I can see.
Yeah. An emphatic no, but with no volume. Yeah, so the answer is no. There's no leverage in the swap arrangement. We're literally swapping 1-for-1 the basket performance for the index performance, and we're getting just a pure exposure to the S&P 500. So no leverage.
Now we've got one question here about taxes and US tax liabilities. I'm not sure whether you'll be able to answer this or not. But the question is, if you hold an S&P 500 tracker in your ISA, I'm trying to kind of interpret this question. If you hold the S&P tracker in your ISA, is there any US tax liability? And is that different versus whether it's in a GIA, general investment account?
Yeah, so I guess the first thing I say is, tax advice is not my thing, and I can't give tax advice. But what I can talk about is what's happening in terms of taxation at the fund level. So there are sort of three tiers of taxation. So there's taxation that applies on the distributions from the companies that are being held by a fund and paid into the fund. The second level of distribution is the fund level, so that's the portfolio level. The next level is the fund level, where the fund is distributing. So if you're buying a distributing share class, or indeed if you're investing in an accumulating share class, where that would be reinvested net of whatever taxation is applied at the fund level. The next level down is then going to be the sort of personal taxation level. For the S&P 500 ETF, we're receiving gross performance effectively at the portfolio level, because we're getting that through the swap arrangement. And there's actually a piece of legislation that is in effect here in the US that allows the investment bank counterparties we're working with to pay that gross performance to the fund without them having to pay a withholding tax equivalent. So there's some legislation in the US that sort of supports this. And then the next level of taxation, the fund level, this is an Irish domiciled fund. So any distribution or reinvestment of dividends is done with zero withholding tax as well, because of the fund domicile. Ultimately, the next level of taxation is the key thing that you need to talk to your investment your tax advisor about.
Yeah, that makes sense. Thank you. Now, what we haven't talked about so much this time, I think we spoke about it on our last webinar, but the eagle-eyed of you who are kind of paying attention to the product demo saw there were two S&P 500 trackers right next to each other, both priced at 0.05%. One was hedged, one was not hedged. What is hedging, and kind of what are the advantages and disadvantages? Would you recommend you hedge your US exposure or leave it unhedged? What are things that investors should be thinking about when they're thinking about that decision to hedge or not?
Yeah. So first of all, hedging is a way of trying to reduce currency risk from the portfolio. So if you take a simple example of investing in SPXP, which is the unhedged sterling share class of the fund, what you're actually doing there is you're investing pound sterling into the fund. It's being converted at the current exchange rate into dollars, and it's being invested in the S&P 500 in dollars. When you come to sell your shares in the fund, the holding in S&P 500 will be sold in dollars, and converted to sterling to return to you at whatever the exchange rate is at that time. So obviously there are a number of risks in that. So one is obviously the investment risk you're taking by investing in equities. Second risk you're taking is currency risk. So if the dollar, in particular, the risk you're taking is if the dollar weakens and sterling strengthens, then that's going to reduce your returns in sterling on a dollar investment. Obviously, if it goes the other way, and the tendency has been more recently over the last decade or so for it to be the other way, that if the dollar strengthens and sterling weakens, you'll get more pound sterling when you exchange at the end rather than at the start. So what hedging is doing is trying to avoid that currency risk. Now, there's no way to do that perfectly, but what you can do, and it's done through the fund, which is the other share class that was there, which is SPXG, I think it is. But don't quote me on that. What that's doing is it's tracking a hedged index rather than the standard index through the swap. But you can do this for a physical fund as well. And effectively, what the index is assuming is that you're entering into currency forward transactions. So selling dollars today to buy sterling at a fixed rate for a future payout date. That has to keep on. That hedging is a dynamic process. It has to keep on being updated, and it doesn't give you a perfect relationship. You can never get the perfect dollar performance just converted 1-to-1 into sterling, but it does take out a lot of the jumps and bumps and lumps along the way.
So final question, I think, just coming in from chat, because we've got about 3 minutes left, so probably the last one. Valuations are pretty high at the moment, kind of an understatement in the US. So I think there's some hesitancy among investors about investing in equities, particularly at the moment. Is now a bad time to be investing in equities, or should investors just be kind of getting their head down, pound cost averaging, and thinking with a kind of longer term mindset?
Yeah, again, a great question. I think, the simple answer is it depends which equities you're buying as to whether they're, looking expensive on valuation multiples or not. So yes, certainly if you look at the S&P 500, it's trading on relatively high multiples compared to history. And actually, compared to other global equity markets, most are looking relatively inexpensive based on historic multiples. If you look at the S&P 500 equal weight index, that's trading on a much more reasonable valuation level. In fact, the S&P 500 market cap weighted is trading at about a 35 to 40% premium, so a higher multiple than the equal weight index, because of the weight of those larger, higher multiple growth stocks that have dominated the market recently. So there are parts of the equity market that you can still invest in at a much lower multiple. So if valuation is your concern, then that may be one thing to think about. And I guess the other thing to say is that, as you've mentioned, pound cost averaging, timing based on valuation is seldom really very much help to investors. The valuation can look extended and continue to look extended for longer than you realize. Or on the other side, if you're buying because you think valuations are low, they can stay low and remain low for a lot longer than you expect as well. So, if you've got a long-term expectation of investing for the longer term, then, investing a small amount on a regular basis, averaging into your investment position is probably the easiest and simplest way of doing that.
Good, that makes a lot of sense. Thanks very much. Right, we're at 5:45 now, so that is just about all we've got time for. I've seen there's been a few extra questions that have come in. If we haven't answered your question today, then we will get back to you over the next few days. You can always email support as well. The email address is support@investengine.com. And if you email in your question, we'll get back to you that way as well. If you want to find out more about any of the Invesco ETFs that we've mentioned today, or any of the other ones that are available on the platform, just click that Invesco banner at the top of the ETF range page that I was showing before, and you'll find all the details there. Right, so all that's left for me to do is to say thank you, Chris. Thank you for your time today. I think that was a really good discussion. And thank you to everybody who dialed in for joining. Hope you found it useful, and see you on our next webinar. Thanks very much.